About the housing market. We've got plenty of updates over the last 2 or 3 days. We could talk about some earnings that are sending some warning signs. How healthy is the average consumer? What is going on with the top 20%? I think we have some signs specifically from Lululemon, and they are frankly not good. What does Fed President Bostic have to say? What about Goldman Sachs? There is all kinds of stuff to talk about today. But first, I want to remind you, yesterday was a family day, so I didn't do any net new interviews. However, I did pull 3 videos out of the archives that you probably have never seen. One, I did shared with you a presentation from 2019 with Jim Ingersoll and the Deal Maker Summit. That interview was that discussion was one of the first times I got to share the one rental at a time story. It is about an hour long. Folks, if you ever wanted to see what I was like in 2019, take a look. I want to know, is the story different? Has anything changed in 5 years except I'm a lot older and not in very good shape? But that be said, also gave you a 30-minute masterclass on getting wealthy. And finally, I gave you the 10 uncomfortable truths. So hopefully you appreciated some of those older videos. Many of them were done 3, 4, 5 years ago, but I hope you enjoy them. So let's talk about the housing market. Just this morning, we got new home sales. New home sales came in at 662,000. That was slightly below the estimate of 675, slightly above last month's reporting of 661. That 661 has been revised to 664. So on paper, new home sales for February were down about 0.3%. What happened? Well, folks, rates went up. Rates went up. Again, 660,000 is a nice clip. We do have some seasonality there. It will be very interesting to see what happens in March because now we have rates below 7%. Yes, folks, I am hopefully made it clear. I am nervous. Rates below 7%. If we stay here too long, we're going to find out. Does active inventory fall? Thus far, we've had 5 weeks of active inventory growing. To me, that is a good thing. That is a sign that the housing market is slowly healing itself. If we go below 6, I now believe we are below 6.9. Will the marginal demand come flying off the shelf, absorb those listings, and then we go back to multiple offers and stupid behavior? To be clear, I am not talking my book. I hate it when people say that. It is great for me if rates go lower and we have buyers come in and bid up houses. I own a lot of that stuff. I don't want it to happen. I don't know what people don't get. I can't believe the hate that I get sometimes about why do you want rates in 7? You're selfish, blah, blah, blah. I'm not selfish. I want what's right for the housing market, not for me. Shoot, drop rates to 5%, see what happens. Some folks don't understand, and it's sad. It's sad. Let's talk about existing home sales. It did come out last week, but we never talked about it. Existing home sales had a run rate of 4.38. We did share that last week, up 9%, but there's numbers behind the numbers. That we did not get to go into because it was reported Thursday and we don't record Friday and Saturday. So again, what happened? Month on month was up 9.5, down, we did not report this last week, down 3.3% year on year. Inventory is up 5.9%, folks. That is a good thing. We are moving in the right direction. It is up 10.3% year on year. Again, that is a good thing. All of these things lead to a better and more healthy housing market. Prices up 5.7%. Again, you and I know all the crash bros talking about 5 and 10% drops this year. When are they going to give up? When are they just going to change the story? I do not know. But it is a sad state of affairs that those folks that are preaching doom and fear still have a following. How can you be wrong for 5 years and have a monster following? I know. Tell people what they want to hear. Don't focus on being right or accurate. Just feed the clowns what they want, and there you go. Folks, at the end of the day, I'm talking about a boring housing market, flat for the next several years. What I'm asking you to do is simply do the work. I am not telling you to buy. In fact, almost weekly, I get a note from someone that says, Michael, I've been waiting for a couple of years. I watched the Crash Bros. They got me. Should I buy now? My answer is always the same. If you are asking a guy on the internet if you're ready to buy, you're not ready to buy. My answer will not change. Do the work, do the work. If you don't know how to do the work, now I can help you. Spent a lot of time creating this course, this community, and the private Facebook group to help you, to get you around people that are doing this. The thing about one rental at a time that I am most proud of is we have people all along the investor scale, from folks just starting to folks that have a couple to folks that have a few. And some folks have a lot. They're all there to help. The private Facebook group, the community that you see on the daily financial news in the comments that take the time to watch this live with me each day is amazing. You want to be in this community if you believe in doing the work. I can't tell you to buy. I won't tell you to buy. I will tell you to do the work. I'll show you how to do the work. That's all I can do. Other things that really frightened me. This scared me. First-time buyers for the month of February, 26%. 26. Now, most of you do not know what that means and why I am so afraid. Last month, in the last several months, we were turning about 28%. Again, on the scale of things, you may not realize what that means. The long run historical average is 40%. 40. So we are running at about 30% below historical average. And frankly, going the wrong way. How can that be? Interest rate lock in. We have folks that are going to be or are accidental landlords. They were given a gift, a financial asset that will likely never be repeated. They're going to stay put. They're going to turn it into a rental. Folks, the active inventory, as we reported earlier, up 5.9%, up 10.3% year on year. It's not entry-level housing. It's luxury. It just is. Not enough people are talking about the bifurcated housing market, but if you're on this channel, you know that that is true. What else is going on? We got Fannie Mae. Fannie Mae dropping a bomb over the week or weekend, I guess. At least that's when I read it. Fannie Mae says, and I hope this is true. I hope this is true. Mortgage rates will stay above 6% until the end of 2025. Folks, that's what we need. We need this. We need this, and we need time. We need years, not weeks, not months, not quarters. We need years to fix the housing market. Fed Bostic, probably one of the more hawkish Fed members, came out and said, I've changed my mind on rate cuts. All right, what do you mean? Well, last time I thought we needed 2 rate cuts in 2024. He now believes we need 1. We need 1. Don't forget the dot plot also had 2 members, so clearly not Bostic, that wanted 0 rate cuts. And we had 1 Fed president standing out on a ledge all by themselves saying no rate cuts in 24 and no rate cuts in 25. Interesting stuff. I don't know if you've seen this, but California is struggling. California is in a lot of pain. What do I mean? Not only do they have a huge tax issue, meaning they have a huge deficit, thank you, Mr. King Newsom, but now California has the honor of having the highest unemployment rate in the nation. Folks, the unemployment rate for the nation might be 3.9%, but in California, it is 5.3%, about 50% higher in the state of California. My question to you, is California leading because, hey, it's tech-oriented? Maybe. Is California arguably one of the largest, or not arguably, is one of the largest economies standalone a sign of the times? Is California going into a recession first? Is the nation coming behind it? I don't know. We will see. On the unemployment front, a lot of people have asked, Michael, when do you think the Fed cuts? So again, a lot of you are asking what month, June or July. My answer today is July. But that's frankly the wrong question. I think the better question is what causes the Fed to cut? My belief is the Fed cuts, X black swan. Let's take that off the table. The Fed cuts if national unemployment rate goes above 4.2. Above 4.2. So we would need to see a print of 4.3, 4.4, 4.5, something like that. Remember last month we jumped from 3.7 to 3.9. So we could be a couple of months away, or that unemployment rate of 3.9 could go back to 3.8 or something. We have seen that over the years. So the answer to the question is when. I'm guessing July, but why? Something north of 4.2 monthly unemployment rate. That is what I'm thinking. Goldman Sachs chief economist Goldman Sachs says, we are years away from the pain of a recession. Now remember, folks, I have the classic definition of a recession versus depression. A depression is when you get laid off. A recession is when your neighbor gets laid off. So some of you folks have already had that happen or know people. That is the difference. But again, Goldman Sachs chief economist, no recession, no mass layoffs, no tepid consumer spending for a couple of years. Now, one of the biggest things that if you're going to study the consumer that you should do is you should study the top 20%. The top 20% of income is responsible for 50% of discretionary spending. I'll say that again. The top 20% of income earners are responsible for 50% of discretionary spending. So if the top 20% get scared or concerned, you could have a problem. So if you want to kind of track that, you should be tracking companies that serve or service that top 20%. Well, folks, we got an earnings announcement from Lululemon last week that should at worst be an early signal. Lululemon is talking about a sales slowdown in North America. I don't know about you, but what I know about Lululemon is they're not cheap. So if Lululemon is seeing a North American consumer that is scared, might be something to pay attention to. So let's see, anything else I want to talk about today? Oh, Redfin will shout out the chief economist, Daryl Fairweather from Redfin. She's reporting today that the home appreciation on a monthly basis has returned to pre-pandemic levels. If you don't know what that means, that's about 0.5%. About 0.5% is the long run average of monthly appreciation. Shout out Redfin and Daryl Fairweather for reporting that, folks. At the end of the day, I hope you have an amazing day. Remember, the shirt I am wearing, Cash Flow Over Everything, is available for 5 or 6 days. You only have 5 or 6 days to buy this shirt. If you want to buy it, you want to have something unique, you want to have something that less than 100 people have, buy the shirt Cash Flow Over Everything. Add it to your one rental at a time collection. Again, you can find 3 great videos that came from the archives yesterday. 10 uncomfortable truths, a 30-minute masterclass on getting wealthy, and perhaps something I will even rewatch, my presentation from Dealmaker Live 2019 with the great Jim Ingersoll out in Virginia. Again, my first opportunity to share the one rental at a time story. If you watch that video, let me know, has anything changed in my story? I certainly hope not. My story is my story. But hey, it has been 5 years. Let me go back and watch it and see if anything's changed. Like, subscribe, comment, become part of the community. Thank you, 107 of you, for watching this live with me. I will say that we only have 12 thumbs up. That's a pretty bad ratio. Now 13. Thank you, thank you, thank you. Take care. Later.